There, it's Mike Wise with Mortgage Wise and your weekly mortgage update. It's been a little bit of a crazy week this week, a lot of stuff going on, but let's dig into some of the details. I want to go over with you a little bit more on inflation and how the Fed is looking at that right now, how the bond market is looking at it, and how Barry Habib is looking at it as well. So before we do that, let's go into a couple of the items here that we want to look at today. So with this in mind, let's look at the Wall Street Journal here. This is Fed Bowman. So the Fed this week, they came out and kept the interest rates the same. So they basically hit a pause on lowering interest rates until any further information comes out as to why they think the economy is slowing, maybe lower inflation or higher unemployment numbers. So until that comes out and they see something different, they're going to hit a pause on lowering rates further, which is not great for us, for the mortgage world, but that's where we're at. So PCE, the inflation numbers came out today. They were in line with what the expectations were. They're still a little bit on the high side, but I'm going to go into that in just a little bit there here to kind of go through and tell you how we're looking at that from a mortgage perspective and how that's going to be a little bit different. So let me show you actually where the interest rates are today. So this is live right now on Friday here. And this is the yield on the 10-year Treasury. So you can see, in fact, I'm going to go like this here, right in this level. This is where we've been trading. It's right between what we say the 25-day moving average and the 50-day moving average. So these are the numbers. This is kind of where we're trading in between. It's tried to break down below the 4.48 level on the yield, but it can't quite do that. If it does, then we're going to see some lower rates. We'll get into the sub sevens, into the high sixes at that point in time if the yield does come down there. So as far as the treasuries are concerned, the prices, we are kind of stuck again in this level right in here in between the 200-day moving average and the 50-day moving average here. So that's kind of where we're trading in between. We've tried to go above this 200-day moving average. We've tested it a couple of times this week and just can't quite get above it. But if we do get above it, we might see a little bit better pricing as well. So it's the same thing, just in reverse with the yields. So at the end of the day, the inflation numbers came out today. There has not been much change on the interest rates at this point in time. So what I wanted to tell you is this is going to take a little bit of an explanation, but this is from Barry Habib. This is a letter that he sent to President Trump, and so it is in his hands at this point in time. And what I want to go over is this letter, and it's going to take just a hot second to go over it, but it is important to where interest rates should be because it does address one of the biggest issues, sometimes in a bad way and sometimes in a good way for mortgage rates. But at this point in time, it is in a bad way. So right now, the Fed believes that inflation is too high. Their favorite measure, which is the core PCE, is at 2.8%, and their target is 2%. And the Consumer Price Index, which is inflation as well as another important measure, is at 3.25% versus their target of 2%. So there's been a lot of going back and forth, and I'm not going to read this all the way. You can if you want to here. But the way that the Fed measures the core inflation, it is flawed. And it is flawed mostly due to the shelter. And the shelter impact is very, very large. So it is the largest component in both readings of the core PCE and the core CPI, right? So it's 18% and 46% for both of those items, right? And so to give you an idea of how much impact they do have, shelter and the PCE is about 4.8% year over year based on the November data, and the CPI is about 4.6%. So that's just the shelter percentage of those items on this on the shelter component of those readings, right? And why we are so concerned about this is both of those readings, that's a lion's share of the perceived inflation, right? But there are other real-time data points that we can get that show a much different picture on the shelter costs. So you have CoreLogic, you have, which shows 1.5% versus the 4+%. We have apartmentlist.com, we have realtor.com, we have Zillow that they can all go to, which show a much different picture, and which tells us that both the PCE and the CPI are overstating the inflation, right? And it takes, based on the numbers that they're looking at right now, it takes over a year to kind of to show, to catch up with those numbers because they're so delayed. But it is a completely flawed methodology that they're going through. So I'll give you an example. The example here that Barry gave is back in 2022, if you were out of the grocery store, you saw prices going up, right? But what the Fed did is they kept the Fed funds rate low and QE and 0% interest rates, right? Which just fueled the fire and kept on, the inflation kept on going and going and going. Had they been looking at real-time data, right, that they used for, especially for the shelter, they would have seen that that inflation was getting out of hand, and they could have taken that problem out of the market by increasing rates sooner rather than later, which again was not, I wouldn't have liked that in the mortgage world, but at the end of the day, it would have kept inflation under control here. So let me show you the shelter lag, right? So this is what happens here. They look, the way that the Fed looks at it is they have 6 different panels, and they take, so it's A, B, C, D, E, and F, and they go January, February, March, April, May, June, and then they go back up here, July, August, September, August, September, October, November, and December, right? And they take this for the first month, they take this out for the second month, and look at this for the second month. They take this group of data, so it's a group of data that they take from a specific area, and they don't go back to it for 6 months. So they're taking different pieces of the pie, which again, they're not great information that they're getting in the first place. But what happens is there's a lag that takes place going all the way down. And in addition to that lag, they talk about signed contracts. So the signed contract in here for this is 6 months. This could be 6 months old as far as the data is concerned already. And so we think that there's at least a 1-year lag in the data for this information. And so it takes a while for them to catch up, right? And so Barry Habib estimates that backtesting supports this lag is approximately 1 year. This also explains why the government is looking at 4.6 to 4.8% in shelter readings when the real numbers is approximately 1.5%. So let me show you how this can impact the data. So right now you have the core PCE is currently at 2.8%, and the shelter weighting of that, I know I'm getting a lot into the details here, but the shelter weighting is 18%. If you look at the government, what they're looking at is at 4.8%. The actual numbers is 1.5% for a total difference of 3.3%. So if you took that difference and took the reading of 1.5% and impacted the core PCE by that number, you would be at 2.2% on the PCE, right? Well, we are currently at 2.8% versus the 2.2%. And if you did that on the CPI, the Consumer Price Index, the rating would be at 1.8%, which is right now is 3.25%. So it's a huge difference. Well, if you were the Fed, how would you look at that differently from a rate perspective and how you are adjusting the Fed funds rate? In addition to that, so that's this here, it would be a completely more realistic picture on inflation. As a result, I believe the Fed would be looking to cut rates aggressively, and the bond market would also improve significantly with mortgage rates closer to 6%. So this is kind of the narrative that that the bond market is looking at, and at the end of the day, we could have a much bigger reading and much different rates as a result of the Fed looking at current data rather than outdated old information, or lagging information is what they use, the term that they use. So in any event, that's just me going over some of the details of where interest rates should be. At the end of the day, there still is inflation out there. There are still some high prices out there, but interest rates should be moving down. It might take a little while for them to do that, but we think there may be some help in February, March to see a little bit lower interest rates. This is Mortgage Wise with Mike Wise with your weekly mortgage update. I will be around this weekend. You can text me, call me, send me an email. I would be happy to help you out over the weekend. Hope you have a good one, and we'll see you next week.